Australia's negative gearing and CGT rules are set to change from July 1, 2027, with the grandfathering cutoff at 7:30 PM EST on May 12, 2026. Properties owned by 7:30 PM EST on May 12, 2026 are generally grandfathered and keep existing negative gearing treatment until sold. Imagine two investors each earning $120,000 who buy a property causing a $20,000 annual rental loss. Investor buys an established property after the cutoff, and from 2027-28 that $20,000 loss is generally quarantined against residential income. Investor A's loss may be used against residential property income in relevant capital gains or carried forward. Investor B buys a qualifying new residential build and can generally continue applying negative gearing against salary and other income. The cash flow difference matters. At a 30% marginal tax rate, a deductible $20,000 loss could reduce current tax by about $6,000. Commercial property and shares remain under existing negative gearing arrangements, while some affordable and build-to-rent investments may differ. Currently, individuals holding assets 12 months can generally get a 50% CGT discount under existing law. From July 1, 2027, the 50% discount is set to be replaced by cost-based indexation and a minimum 30% tax rate on real capital gains. Indexation adjusts the cost base for inflation, so gains above inflation are taxed rather than full nominal gains. The new CGT system is prospective, so growth before July 1, 2027 generally keeps the 50% discount even if sold later. That may require dividing a gain into pre- and post-July 1, 2027 periods for tax calculation. A concession for qualifying new builds lets sellers choose between the 50% discount and the new indexation plus minimum tax method on sale. Which CGT method is better depends on holding period, inflation, capital growth, and an investor's tax position. Key steps for investors include checking acquisition timing, grandfathering status, and whether a property qualifies as a new residential dwelling. Investors should model cash flow without assuming every rental loss will immediately reduce salary income after 2027. Keep reliable records and valuations around July 1, 2027, as CGT calculations may need growth separated by period. These reforms do not replace considerations like price, yield, growth, finance, and risk when choosing property investments. For authoritative details, refer to Treasury releases and auto guidance on negative gearing and CGT reforms. This video provides general information only and is not tax or financial advice. Rules include exceptions and transitional provisions.